Generate figures as much as these, or even these. Dedicating only 1 hour a day, Monday through Friday, without having to risk any of your money starting with zero. Literally, only 1 hour a day, risking none of your money. And that is exactly what I'm gonna show you inside this video. I'm gonna be explaining to you the basics, literally like if you're gonna be starting from zero all the way to 100. You don't even have to know what a Forex pair is, a pip, what is Forex, nothing. I'm gonna take care of you in this video. And I'm even gonna explain how I took some of these winning trades that generated figures just like these for me. This video is for you if you're looking to learn the most profitable skill ever. You want to start a business with little to no money. You want to get anywhere from $1,000 to $1,500 a week as a beginner using my simple strategy. And also if you want to learn how to master your whole entire psychology, 0 from 100, because psychology is a very, very key component to this. This video is going to teach you the right way to get started. Just delete all of the noise that's out there on YouTube. There's just people that explain to you so many complicated things that makes no sense. So this video, whether you're a beginner or an expert, it's gonna be the perfect way to start. And I really wanna do this video because I wanna give you guys the tips that I wish I had at the beginning. I wanna help you guys be able to find financial freedom, have the time and space to do whatever you want. And the point of all this trading is so you can live the life that you really want. So you can have the power of choice in doing whatever you want, whenever you want. And the way that I got all this crazy stuff and live this lavish lifestyle is by swing or day trading in the foreign exchange market, also known as Forex trading. And as I've told you guys in the past, in order to have this, you don't need to have money, spend more than an hour a day in front of the computer. You don't have to quit your job. You don't have to have a degree. You don't need to be a professional in mathematics. You don't have to be all day on the computer. There's a big misconception that people think, oh, if I want to trade or be involved on the markets, I have to be in front of the computer all day. That is false. I probably spend 1 hour or 35 minutes a day in front of the computer max when I'm trading. Literally, all you need is a phone or a computer and you can get profits like these. Oh, and one last thing before we start, you're probably wondering who I am and why I have this type of authority to teach you this kind of stuff. And the answer is I have multiple videos in my YouTube channel where I teach you to make anywhere from $1,000 to $1,500 a week with my strategy. I also tell you my story, how I went from Dunkin' Donuts, where I was literally working at Dunkin' 5 years ago, to now becoming a successful day trader in this space. And also my most recent video where I made $110,000 in one single day trading, where I just recently broke my record for $60,000 in one day. And also leading a community with over 400 students who are in probably very similar condition to yours, where they've generated figures like these, or even these. Now, without further ado, let's get started. So to start from the basics, what is Forex? So Forex is short for foreign exchange. So the foreign exchange is a market where you're either buying or selling of currencies, while the stock market, you're dealing with shares or units or owning a company and all that stuff. When you come to the Forex market, you don't own anything. You're essentially betting that one price is going to go up, or you're essentially betting that price is going to go down. So let's say, for example, Euro USD, you're not going to buy the euro and then sell the dollar. You don't own any tangible currency. You're just digitally betting that price is going to go up or that price is going to go down. So when it comes to trading Forex, you have a ton of more benefits than trading stocks. The fees are a lot lower. You have flexible hours because it's 24/5, so you can either trade in the morning, in the afternoon, later at night. You can literally trade whenever you want because it's 24/5, but there's obviously specific sessions which are the best ones to trade. More on that later during the video, so make sure you stick to the end. There's so much more opportunity to make money versus the stock market. You're literally moving 6.3 trillion every single day compared to the stock market, which compares nothing to that. So what is a currency pair? I'm sure you guys have seen Euro USD, USD JPY, GBP USD, and to the random person, they probably think that I'm talking Chinese, but this is actually a very simple way to look at it. So whenever you have, let's say for example, Euro USD, you have the euro versus the dollar. So essentially it is the euro getting strong or the dollar getting weak. These two currencies together make a currency pair. So let's say on Euro USD you want to buy, you're basically betting that the euro is going to get stronger against the dollar. This can be either for an hour, for a couple of days, for a week. So basically when you buy Euro USD, you're betting that the euro is going to get stronger than the dollar. Whether that's for a minute, for 10 minutes, for an hour, however long it is, you're just betting that it's going to get stronger. Let's say you're selling Euro USD, the currency pair, you're betting that the dollar is going to be stronger than the euro for the next hour, 30 minutes, day, however long it is. So you put both of these together, you have euro, which is the base, and then you have the USD, which is then the quote. So when can you take a trade? So you can realistically take a trade from the second the market opens. So markets open Sunday 5 p.m. EST, and then they close at 5 p.m. EST on Friday. So you have trading opportunities from the second the market opens all the way till it closes. It is open 24/5. But there is a specific time zones that move a lot better, which are New York session and London session. And I highly recommend you don't take any trades at the beginning of the market open or at the close of the market open, because the spreads are so high that they can either cost you a lot of money or take you out of your trade because the spread gets larger. More on what spread is later in this video, so make sure you stick around. So you can literally take a trade whenever you want. As long as you think it's the right trade, it makes sense, all you have to do is just click buy or click sell. Why is the dollar versus the euro the most powerful or most traded pair? Well, I mean, it's pretty obvious, right? Because the dollar and the euro are the most common currencies in the world, and those are the ones that have the most volume in the whole entire market, meaning that the cost to trade on Euro USD is by far the cheapest compared to any other currency pair. So you can make money on Euro USD and it won't cost you anywhere near as much as it would, let's say, on trading the Mexican peso versus the noggin. Those are currency pairs that don't get as much volume, and the fees there are a lot more expensive. How can I make money from trading? So you can literally make money from trading when the market is going up or when the market is going down. I wouldn't rather buy or I wouldn't rather sell. There's been times where I've been buying for a whole entire week, and there's been times where I've been selling for 2 weeks. The money is made on either side because you're just betting. You're betting that the market is going to go down, or you're betting that the market is going to go up. So if the market is bearish, let's say in a situation like coronavirus, when COVID was happening, you knew that the dollars were going down because there wasn't any movement. You know it's going down, you just keep selling with the trend. Now let's say that the economy starts getting better, companies start moving, there's money being made, you know the market is bullish, you just keep buying with the currency to the upside. So you essentially make money whenever you're buying with the trend. That is the easiest way to make money. What is long or short? So this is very simple, right? Or also, what is bullish or what is bearish? So the definition of long is when you're buying. So when someone says I'm long on Euro USD or I'm long on USD JPY, GBP USD, that means that they're buying. That means that they think that the base of that currency is going to get stronger than the other currency on that pair. When someone's saying I'm short, pretty self-explanatory, that means that they are bearish, so they're gonna look to sell the trade. So long means bullish, bullish and long mean upwards. Short and bearish, they both mean that they're headed to the downside. What is a bid-ask spread? So this is actually something very important because a lot of brokers out there that will literally fuck you because they have a lot of spread. So spread is the difference between the amount, how much the dealer is willing to sell you the currency versus how much they're willing to buy it. So let's say right now they say, I can get Euro USD in at $1, but I have to sell it to you at $1.5. Their spread is that 0.5, so that's how much they make whenever they connect your trade to the market. But there's a lot of brokers out there that they can mark up that spread as high as they want. They can mark it up to $2, $3, whatever they want. And if you have a lack of knowledge or not using a right broker, you can literally lose so much money due to the spread. So if you want to use the broker that I use that has one of the best spreads in the markets in my condition, and even when the markets get tough, that the spreads are raised because there's not a lot of volume, they still have the tightest spread. So make sure you guys check out the broker in the link in the description below. They're the ones that I personally trust myself. What is fundamental analysis? So fundamental analysis is whenever you use the news or any type of fundamentals to dictate your trade. It's a way of looking at the market, whether you're analyzing economics, social, politics, anything that may affect the currency positively or negatively. I personally myself, I don't look at absolutely any fundamentals because it just takes away from what matters, and which is the technical markets. What matters is what's in front of you in the screen in the markets. If you're entering a trade based off technical analysis, then you should strictly just stick to technicals. If you're looking at a trade based off of fundamental analysis, you just strictly just look at fundamentals. Personally, for me, I think fundamentals is a waste of time and it is extremely complicated. I haven't used them in over 4 years, and the moment that I stopped using fundamentals, not only did trading get easier, but I started becoming more profitable. So for me, fundamentals is X'd out, but it's good to know what they are. Because half the time, whatever the news are going to say, they're gonna follow what the technicals do. So it's even better to just stick to technicals. So what are these Forex charts, or what are these lines that go up and down? So these aren't actually lines. So these are called candlesticks, and these type of charts, that have candlesticks. These are called Japanese candlesticks. This type of chart is built off of these candlesticks, showing you price action, whether it is going up or whether it is going down. You can see more on this on tradingview.com. This is where I'd say 99% of the people analyze their charts, because it is the easiest way to see these candlestick patterns happen, and then you can take your trades based off of that. And if you want to read a free book on how to read these Chinese candlesticks, the link is in the description below. It is literally super easy. It's probably 60 pages, and it's just pictures explaining how to read the candlesticks very specifically. So when you look at the chart, you understand the whole entire flow of it. What is a pip? So I don't know why people get so crazy about what a pip is. It's probably one of the simplest things, and probably one of the things that you'll least use, because pips are just used to calculate your stop loss and your take profit. More on that later in this video. So a pip is literally point in percentage. This is just to calculate the point in percentage of the currency, whether it's Euro USD, GBP USD, USD JPY, whatever currency pair. This is just how you calculate the points within inside of it. So let's say you have the broker that is buying the currency pair for $1. They're selling it to you for 1.05, like the example we did previously. They use a pip to calculate that spread. What is a lot size in Forex? So this is actually something very key, because a lot of people tend to over trade using higher lots than they're supposed to. So make sure you pay attention. A lot size is basically what you're going to risk per trade that you take. A lot size is what's going to show you exactly how much you're going to make or how much you're going to lose. The bigger the lot size, the more you make, the more you lose. The smaller the lot size, the less you lose, the less you're obviously risking. There's websites out there like MyFXbook, position size calculator. There's many websites out there where it literally shows you how much you should risk, and it literally tells you the perfect lot size you should put on your trade so you don't over risk. I've been doing this for over 3 years, so I don't ever put my own lot size. So I just don't have to do the math. I just plug in my account size, how much I want to risk, what is my stop loss, how many pips is it, and then it literally throws me on my lot size, so I risk the amount of money that I want every single time. But basically what it is, they're just units that measure the trade and size that you refer to how much you're going to risk on the currency versus you're either going to buy or then sell. So make sure you use the right lot size so you don't blow your account or over risk. What is leverage in trading? So this is actually very important because it can be very dangerous, because if you use too much leverage, you can either blow your account, but if you use it the right way, you can make a shit ton of money. So leverage is essentially borrowed money. So you're essentially borrowing money that isn't yours. So it's not like a credit. You don't have to pay this money back, or there's not a penalty if you use it. When you use leverage, is you're borrowing money from the broker or from the investors, whatever, so you can trade a larger lot size. So there's brokers out there that they let you trade with a 1 to 50 leverage, 1 to 100 leverage, 1 to 500, 1 to 1000 leverage, which is absolutely insane. I personally don't recommend anything more than a 1 to 100 leverage, because if you're using now money, or you're having now buying power of something that is 100 times of what your account is, you're prone to be able to risk so much more of your account that you can blow this much faster. So if you don't have that type of buying power, you're literally obligated, limiting yourself to not over risk. So if you have a small account, let's say anything from $100 to $200, I recommend going up to 1 to 200, 1 to 300 leverage, because you might need some buying power to be able to flip your account to 2, 3, 4, 5,000 pretty quick. But if you have anything over 5,000, I recommend you have at least, or at most, a 1 to 100 leverage, so you just don't put your money at risk. What is margin? So I'm sure you guys have seen the memes out there like, oh, I got a margin call because I blew my account. Yeah, that is basically what it is. So margin means that you're trading with leverage, which can increase the potential, obviously, of the returns, because you're essentially borrowing money. So the amount of margin is usually a percentage of the size of the position you're trading. So it obviously varies based off of the lot size you do. So margin is just the increased risk or return based off of the leverage you're using on the account. Different types of orders. So what are market orders? They're basically different ways you can enter the market. So there's 5 different ways you can enter the market. The first one being market execution, meaning get me into the market right now, as soon as I click the buy button or as soon as I click the sell button. You want to get into the price as soon as you click the button, meaning you want to pay what the market is giving you that very second. This is probably what 80% of the traders use, and especially with my community or my strategy, because you enter right away. But you also have buy limit, sell limit, and then you also have buy stop and sell stop. A limit order is an order placed to either buy below the market or sell above the market at a certain price. This is an order that can either buy or sell the market once it reaches to a specific price for it. So they say you want to buy at the Euro USD at 1.5053. This is a buy limit. So in order for you to buy price, you need for price to get there. So you're waiting for price to get to that point in order for you to buy. So as soon as you put that buy limits, you just set and forget and you wait for the market to hit that order. So you don't have to actively be looking at the market. Same thing versus sell limit. You put a price where you want to sell price. So let's say you want to sell, once it breaks a support level and you want it to get you in, that's where you would place your limit order. What is a Forex broker? So basically the broker are gonna be the people that they execute the trade for you and that they make you the money essentially. Like they're basically waiting for you to take your trade. Once they take your trade, let's say you want to buy your USD, they get your money, they connect it to the markets. Once you decide to withdraw, they get the money from the banks and they take it right back to you. They make their money on the spread for doing that transaction. So they're basically saving you the headache of you calling into the trade or having to deal with the bank one-on-one and paying those extra super high fees, because it's just not possible for you to go to a bank directly. You have to go through the middleman, which is a broker, in order for your trades to get plugged in instantly and you get the best prices. So other than the broker, there's two other platforms you're gonna need to make money in trading, and they're super easy and super essential. That's gonna be TradingView, so you analyze your markets. So this is basically where you're gonna have your pairs, you're gonna do your markups, you're going to analyze your charts, whether you want to buy or sell, and then you're going to have MetaTrader, MT4 or MT5. This is where you're going to execute the trade that you analyzed on TradingView. If you want to download MT4, MT5, it's in the App Store. TradingView, you can just go on Google, and then the broker, again, it's in the link in the description below. So if you want to download MT4, MT5 on your Mac or your PC, the broker that I use in their website, they have like a thing or whatever where you can download it directly from them there. So you're going to need a broker, you're going to need a MT4, MT5, and then TradingView to fully analyze and take the trades in the markets. So now we have psychology. So psychology is overlooked by 99% of the beginner traders until they pass 1 year. After the beginner traders pass 1 year, they realize they can't learn anything else in the market because everything is pretty much the same. And once you have a strategy, now you just need to handle your emotions, your psychology. So psychology is overlooked by 99% of traders up to year one. After year one, 99% of traders just need to fix their psychology and not their technical work. As crazy as that might sound, that is almost as accurate as the stats are going to get, because psychology, it's all about yourself. You're the one that's going to decide whether you have FOMO, whether you have greed, whether you have very emotional type of trading, whether you're over trading, where everything at the end of the day is just you. So if you want to know about psychology, I highly suggest you guys go look at my podcast, or there's a bunch of series where I talk about that in this YouTube channel, where it teaches you how to have the proper mindset on trading. So I'm gonna show you guys some real live trade examples. I took both of these trades in my Instagram, Telegram, Discord, like every single social media platform. I post this because I just do all of this for free to give back to you guys. Like I've said before, I want to be that guy that I wish that I had at the beginning of this very, very lonely and endless journey. So this trade right here is GBP USD. So like I mentioned earlier, if I'm buying GBP USD, this means that I am betting that the pound is getting stronger against the dollar. If I am selling, that means that I am betting that the dollar is getting stronger than the pound. So like I said, this can be done in either for a daily time frame, this can be done on the weekly time frame, on the 4-hour time frame. Obviously, the higher the time frame, the stronger the momentum, the stronger the probability of the trade going in your favor. The lower the time frame, the faster it moves, but the faster it can change. So I like to stay kind of right in the middle, which is kind of day trading and then intraday swing trading, because anything under the 4-hour is just kind of scalping. But I do use the lower time frames to have my entry signals and so on and so forth. So if you guys can tell here, these are all of the time frames that I use. I have weekly, daily, 4-hour, 2-hour, 1-hour, 30-minute, and 15 minutes. So I use these three to identify the trend, and then I use these four for my entry. So the first thing that I do when I come into the market is I need to understand, where is the trend going? Is the trend heading to the upside or is the trend heading to the downside? Because I am a pro trend trader, meaning that I'm only looking to take a trade with the trend. So if all time frames are going up, I'm buying. If all time frames are going down, I'm selling. It just makes the trade so much easier and it avoids you losing, because this is the secret to the trading. You want to go with the trend, because if you don't properly know how to identify the trend, you basically catch yourself, fighting against the higher time frames. So the goal is to understand where the higher time frames are going first. So if you can tell here, at the time that I was taking this trade, this weekly time frame was headed to the upside. So this structure was bullish. When the market structure is bullish, it consists of higher highs and higher lows. So this right here is a higher high, and then the higher low would be this structure point right here. So then this would be the higher low, indicating to us that this time frame is currently bullish. So this is where I would get my little toolbox. I would put weekly bullish. This is where I would go to the daily time frame. Then in the daily time frame, I do the same thing. I look for the daily higher high and the daily higher low. So at the time of me taking this specific trade right here, this trade was bullish. As you can tell, this market structure was creating a bullish structure, then it shifted bearish, and then it shifted bullish again. But if you notice, this is an inverted head and shoulders, meaning this is a left head, and then this is a right shoulder right here. So this is also an indication that we shifted to the upside, but another video on that later, right? Because this is a whole other topic. So then this would be the higher low right here. And then this point right here would be the higher high. Again, this is before I've taken this trade right here. So here we have the daily time frame, also bullish. And then when we go down to the 4-hour time frame, as you can tell, the 4-hour was bullish as well. We were basically going bearish market structure here, and then we shifted to the upside. So you can literally see how this channel was bearish. And then if we were to pretty much just see it in a channel perspective, we've broken out of this channel, headed to the upside. If we take this same channel approach here, as you can tell, this channel was headed to the upside, broke out of the channel, retested, we're heading down. Now the same thing, we broke out and now we're heading to the upside. I don't really use this whole channel or like trend line stuff, but it's a very clear indication for beginners to understand this kind of stuff. So in here we understand that at the time of taking this trade, the 4-hour is then bullish. So now, this is where a lot of traders were like, whoa, why don't I just sell on the 1 hour? Why don't I just sell on the 30-minute? Why don't I just sell on the 15-minute? Like, why don't I just get it in a quick sell? Like, guys, this is a marathon. We are not here for the quick money. We are here for the long-term money. So we're gonna do the long-term play. And if you notice, the thing that makes the most sense here is buying. The weekly time frame is bullish, the daily time frame is bullish, and then the 4-hour time frame is bullish. Why in the hell would you want to sell this? It just makes no sense. The majority of time frames are going up, so just figure out a place to go up. So that's exactly what we did. This is where I then identified an area of interest. An area of interest is a zone where it has more than 3 touches in order to indicate as a buying zone or selling zone. So in this case, since we are bullish, we're only looking for an area of interest to then buy. If you notice right here, this is considered 1 touch. This is considered 2 touches. Then we have here 3. Then we have 4 touches right here, and then 5 touches. So this is a valid area of interest because we have more than 3 touches, meaning whether we are above this zone, that means we should reject to the upside. Whether we are under the zone, that means that we should reject to the downside. So at the time of taking this trade, since we are bullish, and now we are above this zone, this should have an indication of going up, just as it did here, just as it did here, and just as it did here. If we are under it, it should go down, just as it did here, and just as it did here these multiple times. So in this case, we are above it, and we have 3 time frames in sync, it's pretty much like a no-brainer to take this trade to the upside. So that is exactly what we did, and we got a beautiful 1 to 2.5% profit. So if you guys see the other videos, I pretty much break down the calculations on how effective these percentages are, but this is exactly what we did. And then after this trade, we then just did the same exact thing. We then found another area of interest. So as you guys can tell, we have now created a new daily higher high, and then this would then be the higher low. So then this point right here would be the higher low. So then again, we only look for an area of interest inside the higher high and the higher low. And this is the point right here where again, we have to have a minimum of 3 touches. So if you notice right here, this is 1, this is 2, and then this is 3. So, well, and then technically we have 4 right here. So whenever we are under this zone, we are rejecting to the downside, we are rejecting to the downside. Whenever we're above it, we're heading up, under to the downside, under to the downside. But whenever we're above, we should head up to the upside. It's just history. History tends to repeat itself. And guess what? That is exactly what we did, and we entered on a second position on this trade. This trade made us almost $100,000, I think in the course of probably like 3-4 weeks, which realistically, like, that's perfect for me. That pays the bills. That's more than enough that I need at this moment right now. So this, as you can tell, because we are trading with the trend, because we are pro trend traders, because we're going with the majority of the market, this trade ended up going so much more to the upside just due to one simple factor, and that is trading with the trend. If I can put one of the most important things with trading, it would be that, and then obviously set and forget. I mean, this is, you know, without setting and forgetting, you're not gonna catch this whole trade. So this is exactly how we took both of these trades right here. So now currently I am waiting for price to come back to my next area of interest, which would then be this one, because we have 1, and then if we look to the left, we have 2, and then we have 3 touches. Again, remember, you need to have an area of interest with a minimum of 3 touches, and the 3 touches are to the body of the candlesticks, not to the wicks. So these are the bodies, and then these are the wicks. So if you notice right here, we're just waiting for the same thing. Whenever we're under, we're selling. Whenever we're under, we're selling. Whenever we're under, we're selling. So whenever we're above, we're heading to the upside. So I'm just simply waiting for price to come back into this area, so then we can do the same exact thing we did here and then head to the upside. Just literally create the next step, the next step. So we just continue going to the upside. The trend is your friend. So that's all for this video. So if you want to know more about my set and forget strategy and how it generates me numbers like these or like these, and it allows anybody to make anywhere from $1,000 to $1,500 a week using my set and forget strategy in only 3 months, literally starting from zero, nothing, not knowing what Forex is, which obviously after this video, you already know what it is. Hit the link in the description below. There's another video in there where it explains more in depth of my strategy. So thank you guys for watching this video all the way to the end. Make sure you guys hit that like and that subscribe button, and I'll see you guys in the next video.